This episode of the Planet MicroCap Podcast is brought to you by Friedman LLP, a top 40 global accounting, tax, and business consulting and advisory firm, providing a full spectrum of services for public and private companies since 1924. Contact Friedman when you will need to raise capital and adhere to U.S. standards. The Friedman partners will work diligently with you to provide the financial assurance, regulatory, and transactional services you need. When the stakes are highest, Friedman makes sure you are well equipped. For more information and to get a Friedman free consultation, please call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com. Again, for more information and a free consultation, call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And you're listening to episode 174. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. For this episode of the Planet MicroCap Podcast, I spoke with Neil Cataldi. He is the principal at Blueprint Capital Management. This interview is a long time in the making, and I'm so stoked that we were finally able to make this happen. If you love microcaps, heck, even if you have the smallest tacit interest in microcaps, you will want to hear my chat with Neil. He's a true blue microcapper through and through, and I think you will enjoy every bit of what Neil has to say about his investing style, experience, talking with management, everything. Thank you again for tuning into episode 174 of the Planet MicroCap Podcast, and please enjoy my conversation with Neil Cataldi. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And my next guest, so I started this podcast back in 2015. And I think I have email trails of inviting him to be one of the first guests on here. We did an interview with him. The last one was 6 years ago. And so this has actually been a long time in the making. I'm so excited to have him here. We got Neil Cataldi, the principal at Blueprint Capital Management, joining me right now. Neil, what's up? You're here. We made it.
I'm here. Yes. The last time I was seen on video was an interview with your father at an LD Micro conference, probably 7 or 8 years ago.
That was a great interview, by the way. I actually rewatched it just before we got going today.
Yeah. So it's fitting that my coming out party to podcast video podcast would be with you. So thanks.
It was only fitting, man. And look, I'm just so excited that you decided to join us today. I mean, there's so many different things that we can go. This is gonna be a true blue microcap classic. We're gonna pretend like this is episode 1. I'm gonna pretend like I'm very nervous and my pits are sweaty and really just but anyways. But for those who aren't familiar with you, like we are, and with Blueprint Capital Management, let's start with your background. Where did your passion for investing start?
Sure. Well, I'm a father. I've got two 12-year-old boys. And I say that because normally when I answer a question like that, I'll start off like a story about college. But actually, as a father now, I think back to I kind of relate to like my childhood more. And it's interesting. I think when I was probably 11 or 12, I opened my first bank account, and my grandfather made a deal with me that whatever I saved in that account for like that calendar year, he would match and give me at the end of the year. So I was like 12 years old, 13 years old. I started cutting lawns and doing whatever I could. And I think it was like $1,000 at the end of the year. And that was my first kind of entry into having money and understanding, you know, what a bank account felt like. When I went to college, I was fortunate enough to have a full academic scholarship to a school called Towson University in Maryland. And because of that, my parents let me get my hands on the money that they had saved for my college education. That was 1997. So it was the beginning of the internet bubble. You know, I feel like I spent more time in college watching CNBC and learning about the market than I did anything else. And I made a lot of money in 3 years, and I lost it all my senior year when the market crashed in 2000. So, wow. So yeah, this story is like, I don't know how much I learned in college, like in class, but I felt like when I came out of college, I had already learned the pain of losing, you know. And maybe one of the things we'll touch on today is like, I think there's a lot to learn in failure, you know, and so failing early in my career gave me a foundation to build off of, where I was always sort of in touch with like risk and what risk meant.
So what were you looking at that time, you know, on that 3-year just insane run that you went on?
I mean, I didn't know what I was doing, but luckily there were a few advisors that, if there was an initial advisor who had worked with my family, and he was great and really was a bit of a mentor. And then I had interned with some other advisors that were a little more in touch, weren't afraid of risk, I should say. And I mean, it was, you know, flipping IPOs that were going 10 to 100 and all these crazy tech internet related things. It was extremely reckless, but you know, therein were the lessons at the time. So.
Well, I mean, at the time, were you looking at, okay, these investments I want to keep for the long term? Because as you said, you lost your shirt in your senior year. So like, were you trading in and out of some of these names, or were they potentially long-term holdings that, all right, senior year hit, everything went to crap, and here we go?
Yeah, it's funny when you look back. I mean, now I feel like obviously I've spent almost, you know, 20 years doing this. Like I really know how to analyze a company. I really know how to figure out what I think might happen in the future, and then make an investment decision based off of whatever that, you know, hypothesis is. At that time when I was 20, I honestly, it was a completely different framework. I mean, it was leaning on other people's knowledge that you trusted, and really just kind of, you know, setting yourself up for failure. I mean, I was investing in interesting technology stories, but I truthfully wasn't smart enough to understand the value of like reading all the filings and reading transcripts and doing the work that I do now. It was really just an incredible learning experience. You know, and maybe that speaks to how easy it can be at times, right? That people that don't have any idea what they're doing can come in, you know, make 3, 4, 5 times their money, and you know, and even like capture it and get out before, you know, a market collapses. But yeah, it was a great experience. When I graduated college, my first job was trading options on the stock exchange in Philadelphia. I worked for a smaller company that was then acquired by Goldman a year later. So I had this interesting foundation there where I was able to kind of learn how people traded without all of the systems that a Goldman would have in place. And then when Goldman came in, got to learn what it was like their way. And I did that for a few years before I started working at Susquehanna, which is one of the largest private trading firms in the country. And when I was at Susquehanna, I obviously was off the floor, but I worked on a desk that was called Market Intelligence, and I covered a sector. And our basic job was to know everything about the companies in our space. But at any point in time, like a trader or somebody on a different desk at Susquehanna might call us and say, why is this stock moving, or why is volatility moving in a certain period? Is something happening with a peer company? Did an earnings date maybe shift from one month to another in terms of options expiry? So what I learned over like a 5-year period there was the value of information, and how, something very seemingly little and insignificant on the surface might actually like be worth a lot more if you knew how to apply it to whatever story would be. And that was an incredible learning experience as well, to just kind of understand the value of that information. I had always, at that point in time, I was playing around a lot with smaller cap ideas myself. And I'd say that was sort of the seed that kind of started Blueprint. After Susquehanna, I went to work for a family office, and have helped them out and been a part of their family office for the past 13 years. But I launched Blueprint over 9 years ago today. And it's been a great experience. I mean, the focus on Blueprint is strictly microcap. It's pure microcap. I'm sure we'll get into a little bit more about what I'm doing.
Oh, yeah. I got a couple rabbit holes we're about to go down. So
yeah, okay, go ahead.
No worries. Before we get back to Blueprint.
Yeah.
So you glossed over this. This is your entire focus, and you glossed over this part.
Yeah.
But yeah. So like you said, while you're at Susquehanna, that's when you started playing around with small microcap. I mean, why? What inspired you then to really start looking at this asset class?
Yeah, I think I was spending all of my time focusing on these large cap names at work and seeing how they moved and seeing what maybe made them move a certain way. And it didn't take long for me to realize that if you move down in size, that those moves could be magnitudes greater. And that if you could wrap your hands around the information and wrap your hands around, certain opportunities and how they might play out, that you could make even more money, right? So it was just the opportunity set that appealed to me. It wasn't until I got into microcaps that I understood the other sort of nuances at play, like institutions moving out of the space because they're just the economics aren't there. And once I got into it, I then learned more about how this sort of information arbitrage really does exist and exists in a big way.
Gotcha. All right. So that gives us a little bit of a framework there. So, okay. So
yeah.
Cut to Blueprint. You said you founded it. What was it? So 9 years ago.
2012.
Right?
Yeah. 2012 started. Yep.
Right. And what was your philosophy with starting, as you said, focus on small microcaps? Why create this? What was the structure? Was it family office fund? Like what was the structure?
No. So separately managed accounts.
Yep.
Fully transparent. I launched it through Interactive Brokers. I launched it with a partner at the time, and really, so part of it was born out of the success I was having. Part of it was born out of the success that a very good friend of mine was having in our desire to work together. And then there was a part of it too that like people were coming to us all the time, and I feel like people that aren't in our industry always want to talk to people in it and say, well, what should I invest in, or what should I do? And it just was complicated to want to give people ideas or help people out. And we thought, why not just create a vehicle and make it clean? If people want to invest, they can. The strategy was pretty simple in the beginning. It was look where other people are not looking, microcaps. Meet with as many management teams as possible, learn as many stories as we can that we felt were unknown. It's always had a growth slant. I feel like I do some value investing, but it's more of a tactical like 6 to 12 month trade than, what the focus is on the growth side, which is long-term, hopefully 3-5 years if it's really playing out the right way. I think I've always had a bit of a tech focus as well, but I'm agnostic to industry. And yeah, in the beginning, it was all of that, and try to identify these inflection points that we thought would act as catalysts for re-rating.
Gotcha. Hey, and I have to ask, because I mean, look, you've been following the space as long as I have. I mean, I started my career in 2011. Actively following. I grew up in a family business that, my dad has all this experience, so I knew about microcaps and everything, but actively following. But you mentioned that, your philosophy is always look where others aren't. I mean, especially with microcaps, have you found that that's gotten more and more difficult over the years, especially with just hey, how many podcasts are there now talking about, microcaps and blogs and everything like that, so have you found it's gotten easier or more difficult?
Yeah, I think that's a really interesting thought, because access to information has changed over the past 10 years. I think, with like social networks, especially Twitter. I mean, the financial Twitter universe is, I think, incredibly valuable at times, and I think it also can be problematic at times. But in a way, it's interesting because you can even then go look to see who knows a name. So say there's a name that that's become a position, and it's never talked about on Twitter. Like, there aren't tweets and nobody knows it. Like, in a sense, that's kind of an interesting nuance, right? That world hasn't found it, right? And if they haven't found it, there's probably a lot of other people that haven't found it too, because so many people, like you said, like to share their thoughts on there. So I think I've also learned too that I don't need to be first. I wanted to be first, 8-10 years ago. And now I actually don't really want to be first, because I think if I'm first, the story's probably too early in a way. I almost want to pay a little more to have a little less risk in a way. Whereas in the beginning, I felt like we had a lot of success in the first year or two. And then there was a period in the middle where there wasn't a lot of success, frankly. And if I look back at that period, the vintage of stock, that company that I owned at that time, has done incredibly well. It's actually a running joke with friends what some of those companies have done, because I didn't participate. But they were stories. It was a lot of investing around what I would call a story stock, as opposed to a company that was really executing. And with the story stocks, I feel like the timeline always gets drawn out. It's much harder to predict when certain things are going to happen. And then there's the pitfall of capital raises, which is always right around the corner, and probably what I would say is one of the biggest risks that I like to avoid. So yeah, a long way of kind of getting around it, but I'd kind of rather not be the first now. And I'm happy to kind of watch a little bit longer until it's more established.
You know what? That's a good segue into some of your strategy when you identify a potential new investment. What are some of the things that you then look for when, you before you reach out or before you take that next step? What are some of those things?
Yeah. So I think the first thing that I do is read all the filings. I start with the 10K, and maybe this is pretty basic. I don't know, but the 10K to me is the perfect starting point where you can get the full story. You can get it how they sort of want to articulate it, and you can get hopefully a lot of detail around different segments of the company and products, and there's always a lot of Easter eggs hidden in 10Ks, and I feel like a lot of times management teams are less willing to put something in a press release, but they need to put it in the filing, so it's buried in there. So I start there.
Well, hold on, before we get to the next part,
yeah.
What? I know Maj Suedan, he's big on info arb stuff. So this is going to be like a Maj question. Like what are some of the Easter eggs
it's a good question. Yeah. So, the first one that comes to mind, I mean, a company I'm invested in right now, obviously this is 10K season, right? So they just put out a 10K and there was an attachment to the 10K that lists subsidiaries. And there was a new subsidiary listed that was called something that would point to a partnership or a collaboration with another company, right? That hadn't been announced and really wasn't anywhere. And so, I don't even actually know exactly what that is today because they're not talking about it, but something as small as that can point you in a direction to something that, may come down the line. And I think that's interesting. I don't think a lot of people are reading the attachments on 10Ks. But that's where, the deeper you can dive, the more little things like that you can find. And maybe we'll talk about like how alpha is generated later in the podcast. But I think one of the ways that I can generate alpha is just by digging deeper and looking harder and analyzing. Not more than everybody, but more than some people.
No, let's go there. So, what are some of the ways in which you generate alpha from finding these little things that maybe some people they overlook or just don't look because they don't read the 10Ks or some of the findings? Well,
so I would say, I was actually having this conversation with somebody not long ago, like how's alpha created? And I think a good way that I've sort of considered is that there's 4 different pieces to it. So there's the analytical advantage that you can simply analyze a company and predict whatever the future is better than other people, right? And I think that's what analysts try and do, right? That's what these analyst notes are. Everybody's trying to model companies and figure out what it is and assign a valuation to it. There's the second piece is information advantage. So, it's tough in public securities, right? Because everything's in the public domain. If you're a specialist, you should, in theory, be in a better position to find info and know the value of that info than a non-specialist. While I think I'm a generalist in terms of industry knowledge, I do actually look at myself as a specialist, like in this corner of the markets, because I think I know where to look and I think I know how to, there's sort of an art to interviewing a management team that I think, only comes with doing it over time and doing it like 500, 600, 700 times. So analytical advantage, information advantage. I think there's an execution advantage, which would be like the trading side of it. Maybe if you're doing private deals, like how you negotiate price and warrants on deals. Frankly, I don't think that's where I'm adding the most value. I don't think that like trading is really that important with what I'm doing. It's important how you get in and get out, but I think the more alpha is generated in the other areas. And then the fourth piece, I think, which is really interesting is like value add. So how can you help the company possibly, right? You can advise management, you can help them get their story out. You can make investor introductions for them. You can, when you get to know them well enough, you can help steer them in the right direction on, maybe like what banks they would want to align with, not that I want to be in names that have that capital raise need, but who companies work with is extremely important. Because some deals get done really well and some don't. And if they don't get done well, big overhang. And so there's lots of different ways to add value. But the first 2 are really where I think I create it, is in the analysis and then taking that information and being able to understand, what it's worth. So.
All right, well then let's dig in a little deeper on those first 2 things. From an analytical perspective, we talked about how you like to go through the 10Ks and maybe some of the Easter eggs that you look for in there. How difficult is it? Because this is something I probably should ask Maj too, because it's only an info arb if you actually know some of the news that the company is putting out there on the press release side. and then being able to take that info, and then when you read the filings, like, wait, that wasn't in the press releases, because that's the info arc, right? Or anything that they publicly talked about, but it's in the public filings. So
yeah, okay. So, a lot of the names that I'm in, and to sort of clarify the space, I'd say my sweet spot is around 100 million market cap. Okay. But I'm invested in names larger, and I'm very frequently talking to and looking at companies that are sub 50, even 25 million. So I think the lower you go, obviously the less sort of eyeballs on it. And I think, definitely if you're not on a major exchange, that can create a little bit more of an arbitrage opportunity, perhaps. But the price isn't efficient in my mind. I mean, one buyer, one seller, can really push things around. So I think it's more just having your thesis on what you think, like why are you involved and what you think the growth might look like and what's going to happen, and then how these little pieces over time either increase or decrease your conviction, right? And sometimes it's not that there's an immediate action that you need to take. It just adds to, like I said, your conviction level of what might happen over time. So I don't know that there are these like these huge, nuggets that are found. I think generally they're smaller, but over time they have an impact on how you feel about a company. Look, some companies, are very open with what they put out there, and just some companies aren't. I mean, my largest position right now is a company that, upgraded from the over-the-counter last year to the NASDAQ. They haven't done conference calls. They just did a raise, and as a part of that raise, this was the first time that they really kind of opened up and shared metrics, and but not a lot is out there. So in that case, reading a 10K, you're going to find a lot more in there perhaps than you would a company that's much more open, does the conference calls, has analyst coverage. And so how you take that information and apply it to the stock is different than how I would, if another company was much more efficient. So
very good. Because here's where I want to get to is I want to take how you take that information when you're doing that analysis. Then I'm going to ask you now about, management and getting those nuggets and information from that, and then equaling how you then value that opportunity. So before we get to on the other side of the equal sign, as you said, your other advantage that you like to, that you feel the advantage you have is that you've interviewed over 500, 700 management teams in the art of interviewing management. I mean, shit, we met at a investor conference, right?
Yeah.
I mean, so for you, how do you evaluate management? Has that changed over years? And is there any specific questions that you like to ask management teams that help you get more information?
Yeah, well, I mean, look, first, I think I always start off the call and just say, take the first 5-10 minutes and pitch me the company, right? Pitch me your story, pitch me the opportunity. And it's very interesting how those conversations could go vastly differently. I mean, you would think it's so simple that they could just stay on that course. But more times than not, when I say 5 to 10 minutes, it's 30 minutes without a breath, and they just go. And a lot of times, they'll take you down a rabbit hole here, take you down a rabbit hole there. And it's not really very focused. And not that I'm that judgmental, but I feel like a strong CEO will be able to articulate his vision and his plan, or her vision, her plan, concisely, and that's a pretty simple process. If I look back at the ones that sort of stood out as being, atypical, I don't know if there's a true correlation to it, but a lot of times those stocks jumped out as being more stories, more of something that's highly promotional than something that, is real business. It's just executing. I love to talk to them. I think alignment of interest is really important. And so obviously talking to them about their stake in the company, how they came into the company, and getting a sense for what their ambition is and what their plan is really interesting. And I'll tell you an example, just because I feel like these anecdotal stories are sometimes really funny.
I was just going to ask you to give us a good story on this.
So,
there's so many.
Yeah. I mean, there's been so many over the years, but there was one last year that was just, I don't know. It was such a head scratcher to me. So it definitely was a little bit more of a story stock. The stock had been performing great. The guy told a very promotional story, disruptive tech product that was in like a pilot phase, and they had disclosed to the street like the number of test pilots, and they were doing a really good job of constructing their story. And you got to the end of the call, and it was just so overwhelmingly bullish that you had to take a step back and have some pause. And so I asked him if he owned if he owned stock in the company, and had he invested his own money, not options. Like, I want to see real dollars, right? And his answer, which, to be fully transparent, didn't actually come on that call, later came via email. His answer was that he does not invest in any of the businesses that he runs, that for him, it's too many eggs in one basket, that he once invested in a company he was running, and due to some sort of investor fraud with that company, he was forced to sell. He lost several $1 million, and it gets better. And he promised his wife that he would never again invest in a company that he was running. And after almost 50 years of marriage, he wasn't going to break a promise to his wife. Now, this was a company that at the time was probably like 200 million market cap. And to me, that's just a giant red flag, several ways over. So, little things like that are humorous after the fact, and you just never know what you're going to hear when you ask these questions.
All right, sorry.
No, I was just going to say, but I do think in terms of the management calls, whereas like in the beginning, I thought that was this tenet of the philosophy. I remember when I was first pitching people to strategy, a big part of it was, listen, I talk to management teams and nobody talks to, and that's how we find these opportunities. What I learned is that so many of them lie. Not that they're like outright lying, like it's a conscious lie, but a lot of times they're just not able to do what they say they're going to do. And if you meet them at an LD Micro, they want to come off like, well, right? I mean, they took their time and they spent their money to go there. So it's a presentation, just like I want to come off well on this, right? But most of the time we
under promise and over deliver. And that's
right, exactly. But they, a lot of times they don't. So, especially like I said, when they're more of that story stock variety. So what I've tried to do is talk to management a little less in the beginning. So now I try and do more of my research first, and then use the management call as like a supplementary part of the process. I found that when I do the management call first, I'm prejudging a lot based on what they're telling me, and they're obviously going to tell it a certain way, before I've already been able to make up some sort of, have some sort of opinion of my own on what I think is happening. So I've kind of pushed that further down in the process. And I think in doing that, I also go into that call. I really want to go into the call prepared. Usually I'll have like a list of 20 or 30 questions that I want to ask. And, it's just Q&A, like just fire through it. But when I've done all of that before, I can sort of dive deeper into the weeds more quickly, which is where I feel like the real value is. And I'm also able to maybe expose like red flags easier that I maybe wouldn't have otherwise, known from talking to them earlier on.
Absolutely. So actually recently, I had Ian Castle on my VAH and crossover episode. And then also he was just on the Value After Hours show filling in for Bill. And he was talking about management on both shows, about how, his mindset has kind of changed a little bit, where it's not that he won't talk to management, but his focus has been more on some of the people around the CEO and whatnot, and seeing what that looks like. I mean, do you go that far too, or
that's funny because Ian and I are good friends, and I don't know that we've had that specific conversation, but maybe he's worn off on me a little bit in that sense. That when you can, absolutely. I mean, that actually, in the early part of this, it was talk to the CEO. Talk to the CFO. I think especially if you're leaning a little bit more higher in market cap, like as you get to 100, 200 million, and there's like division heads or there's other people on a senior team, that those people can be extremely valuable conversations. I mean, the question is, how do you get to them? Will the company let you talk to them? I ask, it happens. I mean, it's not, I think, there's a relationship you can build. And then once you build that relationship and they understand that, you're going to be a long-term investor and that you can advocate for them and you can make introductions. And, it's not like, I don't want to get in and out and just be fast money. Like, I want them to know that I hope I can add value as an investor to what they're doing. So, when you get access to that, it certainly helps with the conviction. And there's tools out there nowadays that they cost a good amount of money, but you can get access to industry experts, and you can, like I just did this trial with I don't know if you've heard of Tegas, but Tegas is a really interesting platform that's had great growth. And basically you can, if you go on there and XYZ company is of interest to you, they'll go find somebody that used to work at the company, or somebody in that space that's like, senior position at a peer company,
really cool.
Like or a customer. And then you pay, you're paying to interview them. And then that actually becomes part of a database that all of their subscribers get to see after an embargo of like a month, right? But using those type of tools to get to experts is a really, that's probably one of the most challenging things to do. But if you can do it, it can add significantly to again, your conviction. So I'm always looking at how I can leverage my network a little bit. I think LinkedIn's great that way.
That's really cool.
Yeah.
I like that idea.
Yeah. And I also think that, somebody like the peer network is huge. I think when people ask me like, what's special about me versus, any other person that's been on your podcast, I don't, I think we're all doing the same thing on the same team in a way. But I love the collaborative nature of what I do. I'm one person running this strategy. It's small. I like it small because I want to be nimble. But larger firms exist where they have, several analysts and they have larger teams. I think if you are able to leverage the collaborative nature of our world today through, people you meet in the space and through other tools that are out there, that you can really create a lot of value around your research process. So, you mentioned Ian, MicroCap Club. I've been a part of that for 10 years. The amount of information and the people ask me about MicroCap Club, And I think a lot of people join because they know it's this great community where a lot of really smart people kind of meet and share information. But for me, while I've gotten incredible information from there, I mean, hands down, it's the people I've met and the experiences I've had with them, what I've learned from those people. You go to an LD micro event and we have a meetup with like 30 or 40 people and you've been a part of that, right? So you know what I'm talking about. And all of these different people have experienced different successes and different failures, and they're all interested in different things. And you're able to take from that. But then, you fast forward 8-10 years, you've cultivated all of these relationships and it becomes a part of your engine in a way. Like I'm constantly talking to people I know. I respect so many people and their ideas and the work that they do, that the flow of information is just, it's just always coming in. A lot of ideas are found through that engine, if you will, and that dynamic. And I think I've grown to really appreciate it because it's a big part of what makes it all work. Some people don't want that. I do. I embrace it. Like I think it's kind of a differentiating feature in a way. So.
Absolutely. I was going to joke, like you've been on the homepage of MicroCap Club, I think forever. Yeah. The same picture. You got to update that picture. Or I don't know.
I'll talk to you about that. I mean, look, I'm more proud of being in the top 10. Okay. If you crack the top 10, listen, there's elite company in that top 10.
Yeah. There's some serious company in that top 10. That's for sure. Yeah.
I think you've had many of the top 10 on your podcast. So.
Listen, I cut off at the top 20, anybody, anybody listening in the club, I'm just kidding. Yeah. Okay. But yeah, no, I mean, as you said so eloquently, like I'm a huge fan of the club. I love it. I think it's probably one of the most high class, well-run groups of investors, not just for microcap, but just period, really just brilliant people. And of course, Mike and Ian, they run a great ship over there. And
absolutely,
we're all a big fan. Yeah. So to bring us back, okay, we talked about the analytical side, doing the research on the company and supplementing that with your skills and talking to management. Now we're going to do the other side of the equal sign. So how do we get to that valuation point? What valuation do you look for? So then you're like, okay, now it's time to start sizing into this position.
Yeah. I mean, valuation today is a really interesting topic, right? Because the market,
for damn sure,
especially over the past year, I mean, is like a straight line up. I feel like the liquidity in this space has just been explosive. It's maybe a little bit less today than it was like late last year and the early part of this year, but the amount of speculative money, retail money, people have been in this space for a long time. We know how hard it is to sort of get in and out of things. And all of a sudden it just became really easy to navigate in a way that it wasn't. So in doing that though, like valuations have really, obviously moved higher for those names that have gone up a lot. I mean, for me, nowadays I want predictable businesses. So, before the valuation piece, it's like finding businesses that have, high barriers to entry, moats. I like a recurring revenue model. We touched on management being aligned. I like high margin businesses. I like businesses that are cash flowing or sort of at the inflection point of doing so. And so if I can predict what I think, the next year might look like in terms of growth, then I don't, and I'm not somebody that needs to put a full model together, but I feel like the higher growth names have really wild multiples at times. And I think by higher growth, I mean like a company that's growing, say, top line more than 30 or 40%. I think there's kind of this sweet spot there where once you get above that, you enter, a different category. So part of it is really looking at like how peers are valued. Part of it is looking at if they're profitable and what that might look like. But it's really just, I think it's more on that top line piece, honestly. And I'm sure other people would disagree with me, but I think it's more on that top line piece. Like if we're smaller down at the end of microcap, it's on that top line piece and how they can really establish that this company is taking off, right? I'm usually in that stage where they haven't taken off, but they're about to take off, or there's a new product launching, or there's a product that's hitting an inflection point, but there's other products around it. And to some extent in the valuation sort of framework, what I've found is that as much as I want predictable business models, it's also really challenging to try and model out like 2 or 3 years what a company might do. I think you have to watch it quarter to quarter. And if they're doing what they say they're going to do and they're credible and the story's playing out the way you think it will, and the growth is coming or the growth is here, you've got to read the blitz a little bit. What I've learned over time is I've sold too early. That's definitely like one of my takeaways from the past 10 years is that I typically have been early. I typically have been in companies that have been hated for a while. One of the things that I think is interesting, we can go down a little bit of a hole here, but I think about pessimism versus optimism in our world, like sentiment, right? I like reading the economists that have more of a perma bear outlook. I don't know, someone like David Rosenberg. They always seem to have these great data points to support whatever their thesis may be at that time. And they're wrong most of the time too, right? So their views are always counter to the consensus. And at some point they'll be right. They always are, because a correction inevitably happens. And this has been like, with that sort of narrative, it's been really tough in the past year because, with COVID and all the unknowns. And, I used to look at like the macro market and think about, well, is a correction coming, and do I need to like structure the portfolio a certain way if that is, and sometimes they use cash as a position, but I feel like if anything, that's been a little bit more of a detriment to me because, the market's generally gone higher over the past 10 years. So you want to stay invested. I'm sure you've read Morgan Housel. He had a great book last year, The Psychology of Money. He's got this blog post that's like a couple years old now and talks about how pessimism sounds so smart, and that like bullish arguments can sound more like reckless cheerleading, whereas the pessimistic view, is more intelligent, requires action, and comes off as like help in a way, right? So, to kind of bring it back to microcap, what I've learned is that, well, one, it's difficult to predict that macro environment. So I try not to do that as much anymore. And if you take it the next step further, it's easy for someone to always tell you that an idea is bad or that they don't like it. I'm guilty of this myself too at times. But every idea typically has some hair on it. And, and so a lot of the things that I've been drawn to over time have actually been names that I guess have quite a bit of hair on it. There was more of this like in my, 5-10 years ago, where I would try and figure out like how that would go away. And then in that going away, the stock would be re-rated because people would get more comfortable with it. And what I found is that that's really difficult to predict, like how that happens. So when I talked about the middle years where like I didn't do very well or wasn't making as much money as I have like in the past, 4 or 5 years, it was that process of companies, going through cleaning themselves up, if you will. And it's especially hard to model anything when the company is at that sort of grade or phase. So my best and worst story is that Digital Turbine, which is one of the largest microcap companies in, it's the number 2 company in the microcap index today. was a dollar stock for quite a while, and I owned it. It was a large position, and it was just checkered at the time. It was widely checkered with problems, but they had really interesting tech. And it's funny because you typically look back and you learn from these things, like you reflect back, and that company trades at $75 a share today. And I mean, that's the type of sort of career defining, career changing trade that you could put on. And the reason I say that, I'll try and tie this all together, is that you asked about valuation. Like, with that company, I would have never thought I would have ever traded at a valuation like that, which it trades today. And I think it's just totally absurd. But, the market loves this company now. Microcap companies that show growth and get embraced and sort of discovered and institutionalized, I mean, the valuations can get pretty wild. It's hard to wrap your hands around that. The psychology around that and the behavior that happens when price starts to work. There's this sort of thing around sentiment where I feel like price dictates sentiment in a way. So when it's hated, price is awful and nobody cares. But like if it doubles, then all of a sudden everybody cares, and they didn't like it at $5, but gosh, they love it at 10. Why? I don't know. I mean, that's just the way it works in a way. But so I generally think more about my downside and how I'm going to lose than, really what that valuation is going to look like if things work, because I find when they're working, I'm probably going to estimate it lower than what it might be. Like if it really works, it's going to take off.
Very good.
Yeah.
Oh man, we could do like 3 hours on like a couple different.
Oh, yeah. Well, I'll come back in like 5 years.
Episode 500.
Yeah.
But,
exactly.
One thing to follow up there. Well, first, are you still a shareholder of Digital Turbine?
No, sadly I'm not. So I don't have to make any disclosure there. Yeah. Right.
I'm sorry.
Yeah, no, I know. Yeah. This is not investment advice. Let me be clear. Not investment advice in any way. Yeah.
Well, for you, I mean, how do you think about risk then? You've made it pretty clear how, look, it's easy for you to build the bullish case. I'd say for anybody here, it's probably pretty easy to build the bullish case. And even for a dog, it's easy to build the bullish case, but it's really having that discipline to say, all right, here's the hair and here's the risk. If I want to deal with the hair that I'm willing to take. So how do you think about risk and how do you manage that with maybe companies that you want to take positions in?
Yeah, I mean, balance sheet number one. Like, when I went through a period of not making money, it was because of balance sheet. Balance sheet caused companies that I was in that I liked to need money and then go down this sort of slippery slope of trying to raise money, not being able to do it quickly, because liquidity isn't what it is right now, where anybody can raise money in like a week. You just have overhang, right? So what I learned in that was that if I can reduce, take that out of my portfolio, then all of a sudden, my batting average goes up considerably. I think the reason I've been successful, like I have over the last 4 years, is that there really haven't been many losers at all, right? So I've had names not work, but they're just flat or they're up small. And then the names that really have worked have just contributed to the bottom line. So balance sheet by far is the thing that I look at. And then I sort of get back to what we've talked about before around business model. Is it recurring? Is it higher margin? Is it lumpy, right? Like a lot of these, I remember years ago getting involved in like companies that had more lumpy business models. And it was you felt like there were landmines everywhere. Like you never knew what the quarter was going to be. It was going to be great or it was going to be heartbreaking, and it just doesn't, like that type of company to me now, it just doesn't appeal like it did then. I want to be able to have some ability to predict what's coming. And I find that in doing so, I'm much more comfortable with the risk, right? Because I'm probably not going to get that surprise to the downside. And if I do, hopefully there's a good reason for it and it's temporary. So looking at balance sheet, I feel like insulates a lot of that. And then, again, just being able to wrap your hands around the business and what type of business it is. I also don't do anything in biotech, so I don't carry like binary risk around FDA, panels. I don't do really anything in the energy space because there's added variables of risk there that I can't wrap my hands around. So the businesses are typically pretty straightforward.
Very good. Yeah. And then my one last question that I had about is on the fund. Well, it's not my last question, but just on the strategy side. I promise I only have a couple more. But on the fund structure, the SMA style, I in doing this pod for many years now and talking with other individuals like yourself that have funds doing the SMA style, you made mention during this that you prefer to stay small in order to stay nimble. Right. I mean, what is that sweet spot then? And then how are you able to execute the small microcap strategy in this style? I'm sure a lot of people listening to this want to know.
Yeah, no, that's a good question. There's been a narrative, which I'm sure you've probably seen on Twitter recently, about like the emerging manager, and I don't know where it started, but I feel like the sentiment around the emerging manager is more negative than it is positive, in a way that it's really hard to attract capital. It's really hard to build a business around doing this, managing money in the microcap space. And I completely disagree. I mean, it's like anything else. Like you're building a business, you're constructing it, and you can do it in different ways. So for me, when I started this, we put a lot of thought into whether we want. I mean, I was going the SMA route because it was a little bit of like a post Bernie Madoff world at the time, right then, when we were piecing it together, and I just thought like everybody should get transparency and should be able to see everything we're doing. And I don't want to ever meet with a client and say, I'll talk to you at the end of the quarter and show you what your portfolio looks like, so you can log into your account, you can see your account every day, and it's just easy that way. The other thing, that I think is really interesting, well, I use Interactive Brokers. So I think Interactive Brokers is a good platform. I don't think it's perfect. Their technology is good. I would recommend it to people that are starting out because it's essentially free. You pay trading costs, but there's nothing above the trading costs. And you can scale very easily. Like I trade, sort of make one trade, and the technology allocates it across all the accounts, right? So it's very simple and it's efficient. And you don't have added cost around like legal and accounting and other things. They custody the money, they provide the back office. So I think if you construct it lean, you can stay small. The economics can work for you. And look, I mean, if you go land, a $10, $20 million client at some point, I mean, maybe you revisit it then. The only drawback that I've really come across with the SMA structure over the past, 8 to 10 years is that there's a lot of opportunity in participating in capital raises. Now I go back, and I don't want to necessarily be in that company, but if it was easier to participate, I think there's a lot of opportunity there, and doing so in an LP structure would make that much easier as well. So, for me, it's like, would I do SMA again? Yeah, I think I would absolutely. But if I didn't, I'd probably do it and try and be more proactive on the deal side.
Very good.
So, does that answer the question?
Yeah, that answered it. That answered very well. Yeah. All right. So my favorite question to ask, and you've given a couple anecdotes today. So I usually always ask, an investor experience that has impacted your career the most, but I'm going to pull your leg for one more management story. Okay. Because listen, we've been, like you said, we've been to all these conferences together. Yeah. I know you do 1,000 one-on-ones at every single one. So You got one or two in you. I know you do.
Yeah. So
that you can say, of course.
Yeah. Right. Well, yeah. So last year there was a company that I had been involved with for years that was merging with another, that announced a merger with another company, and COVID hit, and the merger made no sense. Like the company that I had been involved with was in an industry that took off as a result of COVID hitting. And this merger was kind of like a merger of two companies that weren't really executing well. But all of a sudden, the one company was like, the trajectory had dramatically changed. So it made no sense for these two companies to merge. And so, I talked to management, and you couldn't really glean anything from anything at the time. But I just thought there's no way. And I started talking to other investors that were involved. And, I guess I might have posted something on MicroCap Club that I had heard was forwarded around to the management teams. And so somebody introduced me to the chairman of the company they were merging with. And I did a call with the chairman. And when we started the call, he told me that I was the guy that was trying to break the deal. Like I was the guy that didn't want this to happen and was trying to make waves. And I laughed, and I thought, yeah, I mean, I don't, if only I had that much muscle. I'm not an activist. but it's so like, it's funny. I mean, I guess that's the downside of kind of throwing things out there into the sphere at times, that you never know who's reading it or how it could get sort of passed around. But I'm not that type of investor. And it was quite humorous that like the chairman of this company that I had never invested in, right? Like didn't have any tie to, had somehow heard, who I was and thought that I was trying to make waves. So
did the merger happen?
No, and then the merger didn't happen.
So you got muscle. You got some muscle, man. You got some pull.
It had nothing to do with me, but yeah, the merger didn't happen. And there's probably another podcast on this story, but the company just dramatically was in a different space. So the merger didn't happen. They called it off, and I think they paid a break fee, and the stock went like up 5x in like 4 months. So, I mean, that's a unique, special situation. I'm not looking for that at all, but every now and then, like things like that happen, and this will be the last thing on it. But speaking of things buried in filings, this was one of the best ones I can remember, where and I thought it was a tell, is that the company reported their earnings for first quarter last year, right? After COVID had struck, and the earnings release was like pretty straightforward, right? But then they put an 8K out like a week later, and the 8K revealed that their like pipeline had like exploded, and they didn't put it anywhere else, and they buried it in an 8K after earnings, right? And honestly, I remember reading that and thinking, I wonder how many people are reading this morning, because the company like had dramatically changed overnight and nobody knew it, and the stock wasn't moving, so it was a really unique opportunity to try and take advantage of that. And I guess a pretty good example of, a lot of what we talked about today. So
that's a really good one. All right. Yeah. So to close this out here, Neil, what advice would you have for any investors listening right there that are new to microcaps and, want to learn more, and what's some advice that you got?
Yeah, one, I mean, look, we talked about the emerging manager thing. I'd say definitely get involved. I mean, don't shy away to it if you're passionate about this and you think you know how to do it. I mean, just construct it in a way where your overhead is low, and you can make the economics work for you, even if you don't have, a lot of money. I mean, you start small, you can grind it out, and it takes some time, but you can do it if it's structured the right way. On the research side, read the filings. I mean, there's nothing more basic than that. And I would say, certainly look at the collaborative tools that are out there. Look at ways that you can connect with people, whether it's, a microcap club or whether it's, Twitter. I love when people reach out to me. I reach out to people all the time. I mean, if somebody tweets about a name I'm involved with, I don't know who they are, but why not, just broaden the network, right? So don't be shy to send an email or a message. You might be surprised at who, writes back. And, to that point, the same holds on the research side. I mean, you can get to anybody nowadays. So, send the message, pick up the phone, send an email. People are more friendly than I think, they get credit for in general. So
that's for sure. Especially in this community, everyone's just so nice. And one, they like you they see it as a team sport, and it really is.
It is. I mean? Yeah. It's not me versus you. I mean, honestly, if everybody wins, the whole tide's rising. Right. So
that's right. That's right.
So yeah.
All right. Well, Neil, with that, it's time to let you go. Where can our audience go and find more information about you, follow you on social media, and as well as Blueprint?
Yeah, sure. So my email is Neil, Neil @blueprintcm.com. Feel free to message me if you'd like. I can be found on Twitter under my full name, Neil Cataldi, NeilCataldi. And the website for Blueprint is blueprintcm.com. So look forward to chatting with you.
Awesome. Neil, you lived up to the hype, man. I know. Listen, I know this was 5-6 years in the making, but we made it happen. So
let me know if you want to do it again sometime. I'd love to.
Oh, absolutely, man. This was great. Thank you so much. And again, good luck. Stay safe.
Yeah.
I look for the next chat we have.
Thanks.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.
This episode of the Planet MicroCap Podcast is brought to you by Friedman LLP, a top 40 global accounting, tax, and business consulting and advisory firm, providing a full spectrum of services for public and private companies since 1924. Contact Friedman when you will need to raise capital and adhere to U.S. standards. The Friedman partners will work diligently with you to provide the financial assurance, regulatory, and transactional services you need. When the stakes are highest, Friedman makes sure you are well equipped. For more information and to get a Friedman free consultation, please call 856-830-1660 or email Neil Levine at NLEVINE@friedmanllp.com. Again, for more information and a free consultation, call 856-830-1660 or email Neil Levine at NLEVINE@friedmanllp.com.